$403.4 billion. I mean, just let that number sink in for a second. That is the staggering fiscal 2026 revenue generated by the company we are analyzing today. To put that into perspective, that single number establishes them as an absolute massive engine running quietly behind the scenes of the entire global healthcare industry.
Welcome back to The Explainer. I am so pumped you're here today because we are putting McKesson Corporation, ticker symbol MCK, right under the microscope. We're going to dig through the proxy statements, the recent earnings calls, and the institutional trading data to see what is really driving this titan. Whether you're a healthcare sector veteran or just a curious investor, we're going way past the surface-level numbers. We want to understand exactly how this company operates, the tension between its massive cash flows, and honestly, some of the very controversial financial engineering happening right now in the boardroom. Okay, let's just dive right into it.
We've got 4 key areas on the agenda today. Number 1, business strategy and AI. 2, financial health and growth. 3, stock valuation and sentiment. And 4, governance and capital allocation.
All right, starting off with Section 1, Business Strategy and AI.
So there's this really common misconception that McKesson is just a middleman, a basic physical distribution company, just moving boxes of medicine from point A to point B. But actually, McKesson is evolving super rapidly. Management is aggressively shifting into high-margin areas. They're expanding their oncology and multi-specialty platforms, and they are actively recruiting practices into their U.S. oncology network. But what's really fascinating here is their focus on technology, specifically their prescription, technology solutions, and advanced AI. In their latest earnings call, CEO Brian Tyler specifically highlighted their investment in what they call ambient scribe technology. This AI integration is designed to literally reduce the administrative burden and burnout for physicians, letting them actually focus on patient care. By offering these high-tech integrated solutions, McKesson creates a really sticky ecosystem. It attracts and retains clinical practices, moving them way beyond basic distribution. Now, deploying AI in healthcare obviously isn't like deploying it in retail, right? The stakes are quite literally life and death. So straight from their proxy statement, McKesson has instituted an Enterprise AI Council. As they implement all these advanced tech solutions, they are maintaining a really strict top-down AI governance framework. This structure formalizes responsibilities, sets business-specific AI strategies, and applies incredibly strict evaluation criteria before any single use case is approved. So the key takeaway here is that they are actively balancing rapid technological innovation with serious enterprise risk management.
Moving right along to Section 2, Financial Health and Growth.
The results of this strategy? Well, they kind of speak for themselves. Over just 3 fiscal years, McKesson's total revenue has ballooned from $309 billion in fiscal 24 to $359.1 billion in fiscal 25, hitting that massive $403.4 billion mark in fiscal 26. That is a 31% top-line growth trajectory over this period. They are just successfully executing their strategy, particularly with growth in provider solutions and specialty distribution, which is what's really driving this massive scale. But, revenue is just vanity if it doesn't actually translate to the bottom line. So let's look at their Q3 2026 earnings beat. Gross profit hit $3.7 billion, which is up 12.2% year over year. But notice the leverage here. Operating profit grew 32.3% to $1.6 billion, and net income jumped 34.9% to $1.2 billion. So what should you actually take away from this? Well, operating profit and net income are growing at nearly triple the rate of gross profit. This indicates some incredibly strong margin expansion. The investments they've made to modernize their operations through automation and AI-driven capabilities, they're clearly creating real enterprise-wide efficiencies. All of this culminated in a diluted EPS of $9.59, comfortably beating the analyst consensus estimates of $9.31.
Let's jump right into Section 3, Stock Valuation and Sentiment. There is a super fascinating tension right now surrounding McKesson stock, and I want to lay it out totally neutrally for you. On the bullish side of things, the stock trades at a trailing PE of around 21.3. But if you look at discounted cash flow, or DCF models, the estimated fair value is roughly $1,444.63. That implies the stock is almost 48% undervalued. Bulls also love to point out their incredibly high 34% return on invested capital. But we have to look at the bearish risks too. Recently, CEO Brian Tyler sold $16.5 million worth of stock on the open market. And while executives sell for a ton of different reasons, heavy insider selling is always going to catch the market's eye. On top of that, in Q3, operating cash flow dropped a staggering 151.7% year over year. Now, management noted that cash flow metrics can vary wildly quarter to quarter, just due to working capital timing and, the exact day of the week the quarter closes. But a drop that sharp? That's a concrete red flag that cautious investors are definitely weighing against that implied upside.
And because of that tension, Wall Street is highly divided right now, leading to some massive institutional swings. On one hand, you've got UBS Asset Management adding over 1 million shares. That is an $837 million bet on the bullish narrative. FMR LLC also added heavily. Conversely, you have heavyweights like JP Chase completely removing over 2 million shares, pulling $1.56 billion right off the table. GQG Partners entirely exited their position, dumping nearly 500,000 shares. The smart money is completely split on whether McKesson's steady growth will continue to reward shareholders, or if the debt and cash flow timing issues warrant a strategic retreat.
Finally, let's look at Section 4, Governance and Capital Allocation.
I want to pose a really critical question to you right now. Is borrowing money to buy back stock actually a good idea? Recently, McKesson launched a massive $5 billion share repurchase program, but to help fund their financial strategies, which includes segment separation and these buybacks, they anticipated issuing $2.25 billion in new debt term loans. Now, in an environment where interest rates are significantly higher than they were just a few years ago, borrowing money just to reduce your share count sounds to some folks like that dangerous financial engineering we saw right before 2008. Does the math actually create real value? Or is it just artificially inflating the earnings per share by shrinking the denominator?
Well, management fiercely defends this debt-funded buyback strategy, and their whole defense really hinges on one key metric: return on invested capital, or ROIC. During a recent earnings analysis, it was highlighted that McKesson's ROIC sits at a staggering 34%. For a company with heavy physical distribution assets, 34% is practically software company territory. The argument is pretty simple. The spread between the interest rate they pay on that $2.25 billion of debt and the 34% return they generate internally on their capital is so wide that the financial engineering is completely justified in their eyes. As long as they maintain their strong investment-grade credit rating, they believe borrowing to buy back undervalued shares is highly accretive to long-term shareholders.
Which really leaves us with this final thought from CEO Brian Tyler. He stated, "By combining our operating execution with a more focused and optimized portfolio, we will continue to deliver sustainable growth and create long-term value for our shareholders." McKesson has evolved so far beyond a simple distributor. They are a $400 billion AI-integrated healthcare titan, generating massive returns on capital. But with divided institutional sentiment and aggressive debt-funded buybacks, the big question remains: does this highly profitable, aggressively managed titan's current momentum truly justify its financial strategies for long-term value? I'll leave that one for you to decide. Thank you so much for joining me on this explainer. Keep learning, keep analyzing, and I'll catch you next time.